Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ARM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 171 billion market cap. They're trading at 163 a share, and they have a little over 1 billion shares outstanding. ARM develops and licenses high-performance, low-cost, energy-efficient IP solutions for semiconductor companies. The company was founded in 1990, headquartered in the UK. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 2022 to 2024, almost 950 million. It did come down 45% into the trailing 12 months. Now it's 525 million. They did have really good margins, as high as 29%. It was cut in half to 15% in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's pretty flat, from 550 million to 640 million. And they have good margins. They convert 18% of their revenue into net income. Revenue is a sales for the company, and that goes up a little bit each year from 2.7 billion to 3.5 billion. A pretty modest revenue growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, so all cash flows past year 4, that's 102 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $86 billion. We divide that by 1 billion shares. And we get a calculated stock price of $82. They're trading at $160, so they're trading at a 98% premium. It's a sell according to the model. I gave this company a ton of free cash flow growth into 2028, and it still seems really overvalued. That should tell you something. There are 64 companies in the same industry as ARM, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, only 114 million. These are the investments in property, plant, and equipment. They are debt-free. Similar to AMD, they're also debt-free. They don't pay a dividend. Most companies do pay a dividend in this industry. Look at United Micro, 7.9%. They don't generate much free cash flow, only 500 million. Nvidia is number 1 at 56 billion. Intel is the worst, negative 15 billion. They rank 7th in market cap. They're a little behind AMD, Qualcomm, and TI, really far behind Broadcom, Taiwan Semi, and the biggest company in the world, Nvidia. They have really weak price multiples. They're trading at 267 times earnings and 325 times free cash flow. They don't generate much revenue, 3.5 billion, a lot less than Micron, and Micron is a good amount smaller. Also a lot less than Intel, and Intel is about half the size. We can't look at their 5-year annual revenue growth rate. They haven't been public that long. And the stock is trading a little off its 52-week high, only 11% below, 136% above its 52-week low. Nvidia is trading pretty close to its 52-week high, so is Taiwan Semi. Those stocks just keep going up. It seems like it's impossible to buy these stocks. There's never a good point. There's never a pullback. They just keep going up, especially the top 3. If you put $10,000 into this company when they started trading, you'd be really happy at $27,000 today, a 110% annual return. To summarize, I have them trading at a 98% premium, ranking 3 out of 10. They seem pretty overvalued, so I probably wouldn't buy short term, 2 out of 10. Long term, 5 out of 10. I'm more likely to hold it long term, but it still seems pretty overvalued. I'd like to see a pullback before I bought it. But like I said earlier, these semiconductor stocks never seem to pull back. They just keep going up. Terrible ratio is 1 out of 10, extremely overvalued according to their price multiples. Financials are okay, 5 out of 10. Nothing too impressive. A decent growth over the past few years. Let's take a look at their latest quarterly presentation. This is for the 3 months ending 9/30/2024, even though it says Q2 2025. Revenue for the quarter, 844 million, up 5%. Operating expenses, $500 million. That's up 21%, so it's up more than revenue, which means margins went down. And for the trailing 12 months, free cash flow, $475 million, that's up 45%. So since 1990, they shipped 300 billion chips. That's a lot of chips over 3.5 decades. Our volume has created a base for the largest ecosystem in the semiconductor industry. In Q2, Meta and ARM announced they're working on optimizing Llama. Llama is Meta's large language AI model. And Meta is one of the largest companies in the world. So it doesn't get much better than that when you have a business relationship. They also work on PyTorch and Executorch. They have relationships with some heavy hitters: NVIDIA, Amazon AWS, Google Nest, and Cruise. You may not have heard of Cruise. It's a self-driving car company that's a subsidiary of GM. It was founded 12 years ago in 2013, and they were acquired by GM in 2016. They operate as an independent, autonomous subsidiary. So it's like an independent company, but it is beneath GM. Their focus is on producing a fleet of driverless taxis. We're seeing more and more of that. Have you been in a driverless taxi? I haven't, but I really want to. There are over 20 million developers on the ARM app, 1.5 billion ecosystem hours, over 10 million developer hours. They work with some huge companies: VMware, Red Hat, Microsoft, NVIDIA, Android, just to name a few. They have relationships with many middle-sized companies, not just giants. Here's a total revenue by quarter for the last 10 quarters. $844 million in the most recent quarter. Last quarter was $939 million, almost an even split between royalty, that's the dark blue, license and other, $472 million, the light blue. License and other went down a lot. It's down to $330 million. A year ago it was $388 million, so that's really struggling. But royalty is higher than ever, $514 million. Actually, that's exactly the same 2 quarters ago. But when you compare it to last year, it's up about 25%. Their ARM version 9 product is growing a lot. It was a little sliver in 2022. That's a dark blue on top. And you can see it got bigger, then bigger and bigger and even bigger. Their older products, ARM v7 and older, is getting smaller and smaller. That's about 35% of their royalty growth. Most of their revenue in 2016 was mobile, about 60% of their revenue. For this year, full year 2024, 40% smartphone, other mobile only 7%, consumer electronics 15%, cloud and networking 10%, automotive 8%, IoT, Internet of Things, and embedded 20%. ARM is increasing revenue from markets beyond mobile through a broadening range of products, including CPUs, central processing units, and systems for cloud, automotive, and IoT/embedded. Their revenue guidance for next quarter is $920 to $970 million. Full year revenue, $3.8 to $4.1 billion. And their EPS next quarter, 32 to 36 cents. For the full year, $1.45 to $1.65. They have a lot of contracts in the pipeline. Contract value, $1.25 billion, their highest ever. License and other revenue is down. It was $470 million last quarter, now it's $330 million this quarter. You can see that future contracts are higher than ever. Remaining performance obligation, that's a sum of deferred revenue and their backlog revenue. That's a little under $2.4 billion. It was higher 2 quarters ago, almost $2.5 billion. When you compare it a year ago, it's down a little bit. So this $2.4 billion equals the previous slide, this $1.25 billion, plus deferred revenue. Here's their market share by chip value. The blue line is getting bigger. That's ARM. x86 is the orange, and other is yellow. So you can see they're growing their market share year after year. Let's take a look at the company on Simply Wall Street. Its last price, $163, $175 billion market cap, up 9% in the past week, up a lot in the past year, 128%. It's a pretty new company in terms of being public. It looks like around August or September of 2023, it IPO'd, and that was around $50. It pretty much traded sideways for the first few months, still around 50 by November. Then it had a modest growth over the next few months. In February, it did amazing, from 73 to 150. It doubled in 1 month. And then it came down to 93. That was in April. 3 months later, it reaches all-time high of 185. That was in July 2024. It never got that high again. It came down to 110 the following month. Then it came up, then back down. So by the end of 2024, 125. It did great in January, peaking at almost 180. Has come down a little bit since that peak at 163. Simply, Wall Street thinks this stock is really overvalued. They're really bearish at 59. 34 analysts priced this stock at 146. They also say it's overvalued. And since they became public, they're debt-free, no debt. Equity has been growing from $3.5 billion to $6 billion. And they have a lot of cash, $2.4 billion. Zero debt, lots of cash. That's what you like to see. The CEO's salary, $1.35 million. Total compensation, $70 million. Tenure as CEO, 3 years. 88% of the company is owned by public companies, 6% by the general public, and 6% by institutions. SoftBank, Masayoshi Son's company, owns 88%. Then Goldman, about 0.4%. BlackRock, 1/4%. Franklin Resources, 1/8%. Renaissance, 0.1%. And Susquehanna, 1/15%. Their employee count was 6,300 in 2022. Now it's 7,100. The ticker trades on the NASDAQ, Deutsche Börse, and Buenos Aires Stock Exchange. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.